Welcome, everybody. Welcome, welcome. We'll give everyone just a few minutes to hop on here. I know it always takes just a few minutes for Zoom to let you in. And welcome to our State of the Markets. This is one of the most popular events that we do every year by far. And I think especially this year, a lot of you are probably on here trying to say, Anthony, make sense of all this for me because there's a lot going on, and not just in the world of where politics and the markets intersect, although that's what's in the headlines quite a bit, but also just in the world in general as it relates. So I've got a presentation I'm going to go through with everybody today, as per usual, and I'll kind of cue that up in just a second. But before I did, for those of you who have not had a chance to meet her yet, I wanted to introduce Amy Johnson. And Amy's at the office right now. She is the newest advisor on our team. We welcomed her just a couple weeks ago to get started with us, but she's been in the industry for years. And it's a good thing because we're continuing to grow to the point where it can't just be Anthony and Jeff. And we had the capacity to add someone new on. So Amy has been great. She's been getting up to speed, trying to learn everybody's name and what you're invested in and all that stuff. So there'll be, again, a little bit of a growth period there. But we're so excited to have her. She's fantastic. And you will probably get a chance to meet her at some point. Again, I just want to reiterate, we work as a team. So there's no Anthony's assigned to you or Amy's assigned to you. It is who's ever available when you need to talk to somebody. If I'm on the phone, Amy will be available potentially and will be able to help. So, welcome, Amy. And do you want to say just a quick few words before we get started?
Yeah, thank you, Anthony, for that great introduction. I'm so excited to be here. I am 3 weeks in, and so really enjoying myself, really loving the opportunity to meet all of the clients. And for those of you that I haven't met yet, I really look forward to, having conversations with you in the future. I'm excited for the presentation today, Anthony. So, um, I'll let you kick it off from here.
Awesome. All right. Well, thank you. And who knows, we may even have Amy doing presentations in the future on some topics.
That'd
So,
be great.
um, fantastic. There we go. Okay. Hopefully everybody can see me kind of superimposed onto the screen here. Great. So let me get into it. I alluded to this when I kind of queued this up, but I want to reiterate something. We're gonna go through some information as we always do on the screen. Again, this is called State of the Markets because it's a little bit of a takeoff of the State of the Union, which yes, usually happens in January and we're in February, but that's just how it works. The information that's going to be on the screen is primarily focused on the markets and the economy, sort of divorced from the, topical news cycle that we're all experiencing right now. And that's for good reason, right? You want to differentiate kind of the signal from the noise as much as possible, and that's part of what our job is to do that for you. But I am going to not wade into politics. That's never my goal, really, to do that. That's not my function. But I am going to do my best to kind of talk through with everybody the stuff that's in the news right now, and I'll get more specific. But policies that are being proposed or implemented, some of the turmoil that's been going on politically, again, I'm not going to come down on one side or the other. I'm just going to kind of try to give you the 5,000, 10,000 foot view of it and how that might affect. Because I have had plenty of people call in and say, "Can you just tell me what's going on, Anthony, and what we should be doing? Should we be getting more conservative? Should we be getting more aggressive with everything that's happening?" And despite kind of the news cycle again, and I'll keep saying that phrase because I think it makes it seem like everything's a little more amplified than it is. The market's done just fine this year. I mean, it's been a little bit more volatile this year, no doubt. But if you just look at where we're at right now versus where we started the year, it's kind of been a little ho-hum. If you just look at the total timeline, not necessarily the ups and downs as you get there. So that is a dichotomy from where I think if you would just watch the headlines where you might think things are. And that is a pretty common thread in these state of the markets presentations is what is the headline of the day versus what's actually happening, and how does that affect what decisions we should make. So couple disclosures here. As per usual, again, if you don't know me, most of you do, but if you didn't, I'm Anthony Gerbi. I've been with the team for more than a decade now. I have a degree in economics. I don't always say that, but maybe I should when I'm doing a presentation like this. So this really is in my wheelhouse, just as much as the financial or investment topics are, or the, what's an IRA, what's a Roth IRA. This is something you'll be able to tell that I'm passionate about. And my goal today is to give you the information to be able to, if we need to act on it in terms of, oh, Anthony, you said something that really struck a chord with me. I think, I want to set up a time and talk. That's great. Or if I can hopefully just put you at ease that we have, I think, a pretty good handle, as much as you can, on where things are sitting, and we're continuing to actively monitor. So those are my goals, and maybe you'll learn a few things, a thing or two. I always say I like it if everybody can take away one thing that they learned, if not more, then I think it's successful. So, by the way, if there will be basically a poll at the end of this, which is will allow you to opt in if you want us to follow up with you individually. So if that's something you would like, there'll be a poll at the end. But also, you can just go to our website if something I hit strikes a nerve again, and book a time with us. And Aaron, you could potentially even put our website link to our bookings page in the chat. You'll notice, going back to the very start here, that Amy is now available. So if there's a day where you really, oh, that's my only day I can do it, and I don't happen to be available, feel free to schedule time with Amy, or schedule with me. Again, it's your preference on that. We work as a team, so you're not going to be forced one way or the other there. So, and questions throughout, totally welcome. I will do my best to answer. If it's, what do you think of this policy? What do you think of that policy? I'm going to stick to, the business, market, economic ramifications as much as possible. But of course, those things are all interconnected. So most of you are familiar with Zoom. We've done this many times, but for those who potentially are new, there's a Q&A feature at the bottom. There's also a chat. The chat, if you can select who it's seen by. So if you want to ask a question just to me, but you still want me to answer it live, you're comfortable with that, you can send it just to me in the chat. And the chat, by the way, is where Aaron just posted that link. So thank you, Aaron. And we will have plenty of time for questions at the end as well. So in general, this is our agenda. We are going to look back at 2024, although I'm going to go through that pretty quickly because with the way this year has started, I think we've all left 2024 kind of in the rearview mirror. Maybe other than you're probably starting to think about filing your taxes if you haven't done that yet. So, and if you're not, don't worry. Obviously, we still have till April. But that I have found people have moved on from 2024 very quickly, which is a little bit ironic because 2024 ended up being a great year, by the way, way better than everybody expected, too, myself included. And to put some numbers to that, the S&P 500, you're going to see that on here a lot. I know a lot of you know what it is, but just in case, it's an index or a collective of the 500 largest stocks in the stock market. And the reason why you see it everywhere is because it's used as a proxy. In other words, we say it's the same thing to say the S&P 500 went up today and the market went up today. Those things are very tightly correlated. The market being every stock available, the S&P 500 being only the 500 largest. Actually, a little bit of trivia if you're ever on Jeopardy or something, there are more than 500 companies in the S&P 500. Because there's all sorts of weird little rules here and there. Not important. I just like that fact because it's a little weird trivia thing. Anyway, um, the S&P 500, as the Dow is, as the Nasdaq is, tracks on points, which is just a formula derived from the values of the stocks. More points, better, higher. Down points, it lost money, right? That's all we really care about. What the points are on a given day doesn't actually matter. It's what they changed from yesterday. So to start last year, the big six financial firms, or six of the largest financial firms, had targets for where they thought the market would end up by the end of the year. A lot of these firms, by the way, predicted the market would be down last year, which is interesting. but they thought the market would be somewhere around 5,000 in terms of the point value at the end of the year. JP Morgan was the most pessimistic. They only thought it was going to be 4,200. That tracks, by the way. I had JP Morgan reps telling me they thought there was going to be a recession last year prior to last year. I didn't agree. There was not a recession. So, everybody gets them wrong sometimes. But where did the market actually go? It went to 5,800. It blew the projections out of the water by 1,000 points, by 20% almost. So we had a very good year last year, better than most people expected. Again, I even include myself in that as well. I did not think last year would be as good. Why did we have such a good year last year? And this gets to kind of a soapbox I've been on for months now. Apologies if you've heard me go off on this before. But the numbers, if you just looked at our economic business numbers last year, have been pretty good. Economic growth has been good. Unemployment has been low. Inflation, which had been a problem, really did get under control last year. And so you can see the line on this chart is the market, and this goes by month of the year. But here are some key dates, right? In July, inflation hit 2.9%, a 3-year low. Unemployment did go up a little bit. It hit a 33-month high, but it's still incredibly low relative to history. So we have good, pretty good inflation, not perfect, but pretty good. Really good unemployment, meaning low unemployment, an economy that's growing, a Federal Reserve that's cutting interest rates to try to help make all this happen. And we also had a little bump right after the election last year. You throw all that in the pot together, and the stew that we made was pretty darn good. I mean, yes, there are things we could nitpick. Absolutely, there were people who got laid off last year, as people are getting laid off this year. So it's never going to be perfect. But if you're looking at things in the big picture, things were actually pretty good. And so, in hindsight, it's not super surprising that the market was doing well all while that was happening. Um, so I harped on that last year because I felt like, especially because we were in an election cycle, that the news had sort of decided, and certainly even the candidates that were running for the election had decided that our economy sucked, right? That might be a little over dramatic, but they were pointing out the flaws with it, right? And I'm not saying you can't point out flaws. There are flaws with our economy, but in the grand scheme of things, those flaws were much less significant than the positives, the good things that were going on. Um, if you want to look at something that drives the market, I'm not going to spend too much time on this, but what are the companies in the S&P 500? Are their earnings going up or are they going down? And last year, their earnings were going up. Now, one of the big topics last year was, is that driving inflation or was there price gouging going on? And corporate earnings are corporate earnings. But if you want the market to grow, one of the ways to do that is to see the companies within the market start making more money, right? That's what makes their stock price go up. We had that last year, as opposed to 2023, for example, where they really weren't. And then you can see the big spike in 2021. The hidden little detail in here is this is compared from 1 year before. So you look at 21 and you're like, oh my God, they were making profits hand over fist in 21. Not really. They just recovered from 2020 when things were at the rock bottom. So if you compare 1 year to the year before, it looks like they made so much more just because things kind of got back to normal. Um, what did the economy do? There's a lot of numbers here. I'm just going to briefly go through this. We don't need to have an economics lecture, although believe me, I'd be happy to give one. But these are the numbers for the 4 quarters of last year. And fourth quarter is projected. They usually get those numbers in arrears a little bit. So they're going to be pretty close. GDP growth is just what our economy grew. GDP stands for gross domestic product. I won't get into exactly what that is, but basically, if GDP grows up, our economy grew. And maybe this is a good point to do my usual disclaimer about the difference between the market and the economy. And I think this is something that people in my position or on the news, they say all too quickly, and they never quite stop to explain that, oh, there is a very big difference between the market and the economy, right? The economy is us. It's us going to the store and buying groceries, buying a new car. It's the companies in our economy producing things that we then go out and buy. But when money exchanges hands for goods and services, that's the economy. We as consumers make up about 70% of the economy. So that it's just our daily life. That's the economy. The market means the stock market, means what do the stock prices of the publicly traded companies in the United States and elsewhere in the world, are those stock prices going up, down, staying the same, what have you, right? So those are two very different things. Now, they are very connected, of course. If the economy is doing poorly, if we're going out and buying fewer things, then yes, the stock prices are probably going to go down because those companies aren't making as much money, da 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 da. But they are not the same thing. So, and this, a really good example of this was in COVID. During COVID, the economy was sputtering or stalled, right? Because we were all staying home, we were going out to buy groceries, but our spending was way, 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 way down. So the economy went into a short little recession there. Thankfully, it got out of it very quickly, but there was a short recession. The market took a big dive right at the front and then shot right back up. All the while, the economy was still kind of floundering. And the reason for that is the market is inherently speculative. And what I mean by that is we're betting on where the future is going to go. If you own a stock, your idea is that hopefully the stock goes up in the future and you'll make some gains there. Whereas the economy is just, it is what it is, right? We're not investing in the economy. We are the economy. So I find that that difference is not explained super well a lot. And I like to try to devote a little time to that. I know that was probably a review for some of you, but for some it wasn't, and that's why I try to go through it. So GDP growth at the top, 1 to 3% growth, that's fine. That's not great for your investment returns for a year. That'd be pretty low. But for our economy, that's actually pretty decent. We had a pretty decent economy last year. I would say decent to good, even. Our unemployment rate, I mean, being south of 5% unemployment is a very good number, but 3.8, like we had in Q1 of last year, first 3 months of the year, that is, we're talking 50-year low levels. I think technically our recent low was pre-pandemic. It was like 3.6 or 3.5 or something. But we're back to pre-pandemic unemployment levels. No doubt about it. We have been for a little while. So that's very good. Um, Inflation, it was 3.5% to start the year. It was 2.7% to end the year, right? And yes, it did drop to 2.4 and then back up to 2.7, but it trended downward. And that's what we were looking for. Inflation got better. Consumer sentiment index, that's just a poll that's done. It's actually the thing that caused the market to drop Friday, I think, or Thursday, when sentiment dropped a little bit, so the market sold off. It's kind of been bouncing around, right? It started at 78, ended at 72, but it's been relatively in the same place. And home builders, that's an important indicator. I won't get into that all. So overall, that was pretty good. So now it's taken almost 20 minutes, but we've gotten to the part that you probably all logged on for, which is, okay, what's going on right now? And to start that conversation, I like to show these for these presentations. This is put out by a company called City National Rockdale. They run investments, they're a large firm. They put out these speedometers, which is where are we in terms of is this factor in a good place or a bad place? And I want to take you back to January 2023, so 2 years ago now, when we had just come out of 2022, when 2022 is not a good year for the markets or for the economy, really, although the economy was a little better than the markets were. We came out of that and everything was mediocre to bad, right? And you can look at all of these dials, mediocre to bad. Some things were okay. Labor market was okay. Consumer spending was okay. Some things were not as good. International outlook, interest rates weren't in a good spot. So where did we go from there? Well, by 2024, and I'll just flip back and forth for a second so you can just see the color changes, we got a little better. By the beginning of last year, things were in a little better shape. Nothing was looking really rosy necessarily, and hence why all those big companies predicted the market wasn't going to grow very much, if at all. But it wasn't terrible. It wasn't terrible. And now fast forward to January of this year, and look at the change. There's First of all, there's green on the page now, which should be good. By the way, geopolitical risk, we've been doing this presentation for like I don't know, 5, 7 years now. I'd have to go back and double check. I don't think that's ever been anything other than red in my memory. Maybe it's been yellow once. Geopolitical risk is always just, there's like never a time when geopolitical risk like works in your favor. It's always going to be a potential negative depending on what happens. And I promise I'm not going to go through every one of these dials. But if you look, really the only thing that we're a little concerned about is what they call equity market valuation, which is just a fancy way of saying the stock market's a little expensive right now. And I totally agree with that. That is one of the big trends that is being, I think, overlooked in the news cycle because everybody's so focused on the politics of it. The equity market, the stock market's been a little overvalued, and that's a relative term, but it has been expensive for months now. And that really has very little to do with politics. It has everything to do with the fact that the market's been on a 2 year run of double-digit growth. And so things have gotten relatively expensive. So for those of you who I've talked to in the last, 4 or 5 months, you've heard me say it's a little expensive right now. Probably not the absolute best time to buy in to the market with new money. Not necessarily a terrible thing, but if we're trying to buy low, it's not really a buy low time. And it's probably a good time to look at trimming some of the big gainers that you've had because the other side of the buy low coin is to sell high, right? So things have gone up a lot, which means they're expensive, which means if we're choosing whether to buy or sell, I lean a little bit more towards the sell. But of course, it's a case by case basis. But overall, things are actually pretty good if you look at the hard economic numbers here. So one of the things we're watching is, people always ask, where's my crystal ball? And what does my crystal ball say? And of course, I don't have a crystal ball. I don't know what the market's going to do this year. I have opinions about what the market might do this year. They're educated opinions, but that doesn't mean they'll be 100% correct. In fact, they almost certainly won't be 100% correct. But one of the things we look at, there's a list of indicators, and I won't go through all of them, but it's everything from unemployment rate to industrial expenditures, stuff that economists put together and nerd out over. And if they go down, the correlation to the market can be indicative, meaning if these indicators go down, and they're called leading indicators because they happen first, that sometimes means that the economy or the markets may be apt to go down soon. And you can see we've been trending down over here on the right side. I won't cover up the years, but 2023, 24, 25. Yes, we've been trending down a little bit in these indicators. Part of that was on purpose because of the rising interest rates that we did. So we wanted this to trend down a little bit because the economy, frankly, was overheating coming out of COVID with all the money that was flying around. And we needed to slow it down a little bit. The goal was to slow it down without slamming on the brakes and getting the airbag to deploy and blowing us back into a recession. So far, we've been able to do that. This may be, and we've still got some time before I think we can definitively say it. This may be these last 4 or 5 years, the first soft landing that we've achieved in, I would argue, our entire country's history. Maybe even, I'm sure there's an obscure example somebody can throw at me from like, well, don't forget about Albania in 1985 and what their economy did. Okay, I'll grant you that. But in the United States, which has been the largest economy in the world for some time, we have really never made it through a cycle where interest rates had to go up to stop an overheating economy without a recession happening. It's virtually never happened. So far, that is what's happened. Now, I'm not trying to jinx it just by saying it out loud, but we have managed our way through these rising and now falling interest rates without having a recession thus far. And fingers crossed, we will be able to continue that, and that will be a really profound accomplishment, in my opinion. But we're not completely there yet. And what this is really showing me is that, yeah, things have slowed down because of interest rates, but now it's about getting them to kind of trough and then kind of ride that wave back up a little bit. That's what we're looking for. So, what are we looking at? This is the part where I'm going to start talking about a little more policy, right? Because the way it's posted on this slide is very down the middle, very cut and dry, I guess maybe is what I'm trying to say. what could be an issue that works against us here? Well, inflation. It says resurgence in inflation, but why would inflation resurge? It could be for multiple reasons, but one of the things that can contribute to inflation is tariffs, right? Historically, tariffs have contributed. That's the first time I've said tariffs this whole presentation. I think I should get an award for not for making it this long without saying it. So, tariffs. What the tariffs are, what they could or might be, because again, I think we're probably going to go through a few cycles where it'll be, hey, Canada and Mexico tariffs, here we go, they're on. And then a day later, oh, hey, President Trump had a very productive conversation with the Mexican president or the Canadian president. And they're about to have elections too, if I'm not mistaken. So that will be, interesting to see if there's a change there. There will be a change there. But very productive conversation. Tariffs are off for another month, and then we do it all over again the next month, and it's sort of this bargaining chip, and to see if you can extract anything from them. And for me, that is what it is. Like that's what they're going to do. That's what this administration's policy has been. I would prefer it if we didn't have tariffs, or had much smaller ones or much more targeted ones potentially, because in general, tariffs do cause things to get more expensive. I do understand if you're wondering, like, these tariffs from everything I'm hearing, they sound like they're bad all the way around. What's the strategy here, Anthony? I'm not saying you have to agree with it, but it seems like the strategy from the Trump administration is let's keep corporate taxes low and let's keep tariffs high or higher at least. And in theory, the revenue, I don't think they would make this argument, but in theory, you could say, well, we're cutting our government revenue through taxes on one end, but we're increasing it over here. And, maybe we can get some benefits for it. I think whether that works is a question mark. I think even they would admit that because it's just such a huge system that you can never quite tell how these things are going to work. But I would guess that would be their argument. Again, just so you know, and I've said this before, tariffs are paid by the U.S. company that imports the foreign good. So when we say tariffs on Canada, it's not the Canadian government that's now paying the U.S. money. It's the U.S. company that's bringing in the Canadian goods that's paying the tariffs. Just like when you go up, my dad every summer goes up north to Canada for a fishing trip. They go through the border crossing, right, right on the way to Thunder Bay there. And if you stop there, at least there used to be, I haven't been up there in a while, but there used to be a duty-free shop. I'm assuming there still is. Well, duty-free just means you don't have to pay personally any import tariff on any of the goods you're bringing in. That's a tariff. You're the one paying it, right? When you bring something from across the border in and you have to pay an import duty on it, that is a tariff. And now our companies are being forced to pay that, or potentially will be, by these new rules. What does that mean for us? Well, potentially and usually they just pass on that cost to the consumer and they raise the prices of whatever they're importing to match it. Okay, it's not always that simple. It can be more complicated than that, but that's in general how it usually works out, at least in the past. So it's something we're watching really closely because if tariffs do get implemented in a big way and the economy slows down because of it, or at least in prices go up and interest rates are a question, then that does have an impact at the end of the day on the markets too. And it will be something we'll need to watch. At this point, my opinion, I don't believe we need to be reactive to these tariffs at this point. It's a little bit of a wait and see. Part of that's because the market's already high anyway. And so probably what the market's going to do is what it was going to do regardless of the tariffs. They just might make a difference on the margins, is the way I put it. By the way, I should have said this before I got into any specific policy. The way I think about policy, government policy, as it relates to the market or the economy, is exactly the image on the screen above my head here. It is either a headwind or a tailwind, but it probably doesn't change the direction we're going. Okay, forget about the words on the right-hand side for a second. I'm going to go back and forth between these two slides, headwinds and tailwinds. The paper airplane icon that's above my head, it's still flying in the same direction, right? But with a tailwind, it's going to get there a heck of a lot faster. With a headwind, it's going to take a lot more work to get there, right? That's how I think about politics. It's not necessarily that I think a policy is going to throw us into a recession all by itself or tank the market all by itself. I think it's more of a headwind or a tailwind conversation, and it's just about how fast we're going to get there, where we were already going to go. Is I think that's a good way to think about it. It's obviously an analogy; it's not perfect, but I think that's a healthy way to think about it, maybe. Um, our second bullet point here, recessionary pressures. Okay. And what are that's a very broad way of saying what are the things that could cause our economy to not do so well? I would throw tariffs potentially into there, depending on what they do to production and imports and all that stuff. Although, I'm not saying tariffs have to be a universally bad thing. By the way, I just saw, was it yesterday? It might have been over the weekend. Apple announced they're going to invest, 500 billion more into the U.S. The headline kind of intimated that it was maybe, well, because of tariffs with China, Apple wants to put more of its production here. It could have been that they were going to do that anyway. I don't know for a fact. I don't know if Apple said that. But, in theory, if you incentivize people to produce more here, they might. So, I'm not saying it's only a negative thing. I'm just saying there are some negative things. Recessionary pressures, I'll tell you the thing we're watching for most closely, and it's not anything to do with the, Department of Government Efficiency or Elon Musk or all that stuff that's been in the news lately. Not that that is meaningless, but that's not really the thing that I think is going to make a difference for the economy. The one policy that we are watching very closely is the mass deportation plan. Okay, which is already being implemented. You're already seeing on the news, about ICE and finding people who are undocumented or in this country, illegally. And I know this is a very political topic, so I'm not going to weigh in on the moral questions here or even the political ones. But it's a complicated thing to think about because if the administration or the federal government, let's say, were successful in deporting millions of immigrants, illegal immigrants, if you want to call them that, whatever, right? That could be a detriment to our economy, at least in the short term. And I say that because, yes, a lot of these people here are undocumented or improperly documented, but a lot of them are also working and they're filling jobs that we kind of need to be filled. I mean, I remember one of the examples I've used is last year, even, there were stories about farmers who were having to let crops rot in their fields because they just didn't have the human power, the pickers, to get the crops out of the field in a timely way to get them on store shelves and blah blah blah. They were already experiencing a labor shortage. Well, that is an industry that does heavily rely on immigrants, legal and otherwise, to supply it with workers. And if you're taking away a chunk of that labor force, that could have implications. Now, again, there are political reasons why, and again, I'm not even going to get close to the moral side of the equation, one way or the other. So I'm not saying I think the political thing here is less of an economic justification and more of just well, we're going to enforce these border laws as we see them, right? But as they do that, I am watching very closely to see how big of a vacuum they're going to leave behind in terms of all these workers being pulled out of their jobs, right? So now, a couple things with that, because I've had people talk to me saying, "Oh, I'm nervous about that too, Anthony." First is the scale at which it's happening right now, and I'm by no means an expert on this, but the scale at which it's happening right now doesn't seem to be enough to really put a dent in our economy like I'm worried about. In other words, these local, where you'll see on the news, oh, a family in your area was targeted by ICE or was, whatever. Um, as much as that's an individual news story and worthy of being reported on, that's probably not going to change the economy all that much. What I'm talking about is if they're going to set up, camps and call in the National Guard and we're going to do this on a mass scale, that's what could affect the economy. I am skeptical that that will happen, mostly because of the logistics that would be required. I mean, just think about that. If we're talking about millions of people that we are all of a sudden going to move and send to Mexico or elsewhere or whatever. Again, I'm not going to get into the policy part of it. Um, that is a huge undertaking logistically for anything, especially the federal government, right? And there's going to have to be money appropriated from Congress for it. And it's just going to be a nightmare to deal with. So that makes me skeptical that that level of it is going to happen. You might disagree with me. You might say that, no, I think that is going to happen, Anthony, but I remain skeptical. And as long as something like that doesn't happen, I think this will not be tank our economy or the market all by itself. Again, it might be a headwind. It might be a headwind. When you think about the actual ramifications of this, by the way, of a mass deportation, again, I'll use the farming example. If there's even fewer agricultural workers than there were before, does that impact production? Can farmers are going to say, well, I can't actually plant as much because I won't be able to pick it all anyway, so I might as well plant less. And then less goes through the supply chain, less ends up on our grocery shelves. Fewer products means higher prices generally, right? If the same amount of money is chasing fewer products, fewer goods, prices go up. You've seen it with eggs, which is not related to deportation at all. That's related to the bird flu problem. But eggs are very expensive relative to history right now. And so they've gone up because there's just fewer eggs out there. It's just supply and demand. That's what the impact of this could be. So that is one policy that we are watching very closely. Because I say in general, policies like this can't or don't, not that they can't, but they usually don't turn a good economy into a bad one or a good market into a bad one. But something on a massive scale like that, that is the type of policy that could do that if implemented poorly or on a scale that, again, leaves a vacuum in our workforce, in our labor force. So I'm skeptical, but we're watching it. Geopolitical tensions are always going to be a thing. I think the tariff conversations only are ratcheting up these tensions. Now, of course, I haven't said Ukraine once until right now. That's been in the news lately with how that's going to go in our relationship with both Ukraine and Russia. Um, haven't heard a lot from North Korea lately, but I bet they'll be back in the news before too long. Iran, some of these countries that we're just at odds with, maybe is that's kind of the most peaceful way I could put it, that we're at odds with them, right? That stuff is still going to happen. There's going to be more elections. There's going to be a new Canadian leader. The Mexican leader has she's drawn a pretty hard line in terms of relationships with America. I mean, if you were like me and you watched the Four Nations hockey games last week with the U.S. and Canada, you know that Canadians don't necessarily, at least I think it's overblown when they're booing our anthem, and I wish they wouldn't do that. But um, I think they're more just trying to send a message versus really that they hate America or something like that. But tensions are running a little bit higher right now, right? And that can affect things that affect the economy. That can affect tariffs, right? Because tariffs don't just go one way; they come back at us too. And other countries can put tariffs on us when we put tariffs on them, and then it's kind of this spiral, right? And that's not a good situation to be in where you're continually escalating things. There are conflicts around the world right now. We continue to believe that the Russia-Ukraine conflict is not going to, again, be a make or break for the global economy. Not that it's not a terrible conflict, of course it is, but just if I have to divorce myself of the military and political realities and just think about the markets and the economy, I don't think it's going to have a big impact. We feel confident that the Israel-Palestine, Israel-Gaza conflict is not going to impact the global economy. We felt that from the beginning, and I really don't think it has all that much. But of course, it's going to dominate headlines. Of course, it's going to change how countries interact with each other. And that, at the end of the day, does have impacts, at least potentially in the future. So the real answer to what do we do about this is we wait and see what happens. You can't necessarily predict this stuff super well ahead of time, but I think tensions have been escalated in the last couple months, to say the least. Labor market weakness, that's a very insider term to mean what's unemployment doing? Are there enough jobs out there for the people who are wanting them? Are the jobs, quote unquote, good jobs or higher paying jobs? One of the things we had working in our favor over the last couple of years, we had way more open jobs than we did job seekers. And that actually is still true, although the margin has come down. But one of the questions is, and by the way, I think this is why we avoided a recession coming out of this 2022 when the markets were down and out of the pandemic when cash was moving around like crazy. One of the reasons we were able to avoid a recession is as opposed to 2008, where when you got laid off from your job, it was straight to the unemployment line because nobody was hiring. These past few years, if you did happen to be laid off, and there absolutely were people who were, you were able to potentially find a job you were able to find a new job. Maybe it wasn't as good of a job or as high paying of a job, totally, totally fair. But at least it was a job. And from an economic perspective, that's much preferable to going on unemployment for the overall economy. So that is one of the secret sauces that we had available to us. And that margin has come down. So it's another thing we're watching. Potential tailwinds. What could work in our favor going forward here? Artificial intelligence. It's going to continue to completely innovate or revamp our economy. You've seen it in the market with some of these chip manufacturers going up like crazy. You've seen it as its impact for all of us with kind of the consumer grade stuff. But now I know that every online account that you have has a little AI bot in the down in the corner. It's like, ask me a question, I'll answer it for you. My mortgage has that, right? It's like, what do you want to know about? I'll have an AI will answer it for you. That's just the tip of the iceberg. This is going to probably completely revolutionize our economy, and therefore we don't even know what the consequences are going to be yet. But in an ideal world, and I think you'd be right to be a little skeptical of it and say, is this going to be a good thing, Anthony, or is it going to be a bad thing? It's probably going to be both, to be totally fair, just like the internet was kind of both a good thing and a bad thing. Hopefully, it's more of a good thing than a bad thing, but I definitely think it's the future and potentially could drive growth in some areas that have not been growing. It helps get more efficient. I could give you tons of hypothetical examples, but they'd just be hypothetical. So we'll leave that for another day. Monetary easing just refers to the fact that interest rates may continue to go down. You might say, I kind of like getting 4 to 5% on my cash in a CD or in a money market account. And, I agree with you. That's not a terrible thing. But long term, our rates probably need to be lower than where they are right now. What that means for all of you as investors, by the way, is eventually, we're not quite there yet, but eventually CDs, money markets, they're not going to be giving you enough interest to really be good investments anymore, in my opinion. And we're going to have to go back to your meat and potatoes stock bond mix that sort of uses the stocks for growth and the bonds as the hedge or the diversification against the stocks. I think that's what the future will continue to look like. We've been in this short period where rates have been higher and you can get away with having some cash. More power to you. But I think that period is coming to an end, maybe a little more slowly than we thought. But over the next couple of years, I think we'll be back to very low interest rates again. And improving corporate profits. I know that sounds like it's, in the news that would be a pejorative, these, greedy corporations. But as investors, you own stock in these corporations. And when their profits go up, you make more money. So from an investment perspective, it is one of the things that we're looking for, how our company's doing with their earnings. I mentioned that the market is a little high right now. And this is a chart that shows that. So this goes back to 1994. I'm going to not overwhelm anybody with all these graphs and charts that I look at. What I want you to look at is the pink dotted lines. The one in the middle, this is a measure of the price of a stock versus the earnings of the company that the stock is an ownership of, right? So if the stock price to earnings is very high, that means the price of the stock is very high relative to how much money the company actually makes. That is an indicator potentially that the stock could be overpriced, right? Or you're betting on future growth, not earnings that are already there, is another way to interpret that. So the three dotted pink lines, the one in the middle is the average of where the market is. Now you can see the dot-com bubble is right under me right now. And 2008 is under me right now, the big dip in the middle. And then this big sharp drop and then rise. That's the pandemic, right? So we can kind of find some landmarks here. But right now, we are above our long-term average by a pretty decent margin. In fact, we're not quite to dot-com bubble levels yet, but we're on our way there potentially. That doesn't mean a recession's right around the corner necessarily. By the way, this drop right here in 2022, that happened without a recession. So it's important to remember that just because this thing changes doesn't mean a recession will or won't happen. But when I say the stock market's a little expensive, that's where I'm getting that information from. So forecasts, what do we think about this year? In general, um, I am cautiously optimistic about this year in terms of what the market will do. I was cautiously optimistic about last year, and I was wrong because I should have been very optimistic, right? I'm cautiously optimistic still this year. I don't think we're going to get a third year in a row, if I had to guess right now, of double-digit strong market growth. I could be wrong, and if I'm wrong, then I guess I'm too low and it'll be even better. But I also am not necessarily predicting a down year. Again, this is my personal opinion. There's no guarantee that I'll be right. In fact, I almost certainly won't be. I won't be perfectly right, at least. I'm just trying to be somewhat right. So, why are we cautiously optimistic versus a little pessimistic, you might ask? One of the reasons is earnings per share, that's EPS of the stock market, is projected to go up. And again, what that means is are companies going to make money this year or aren't they? And we think they are. Okay. So that's baseline. That's all that graph is really telling us. What are interest rates going to do? Okay. And I did not make this graph. I hate this graph. Not because it's wrong or it's misleading, but because these bottom numbers are put in basis points, which is a fancy term that people in my industry use, and I know what it means, but nobody in the real world talks about basis points. It's only in the financial world. What you need to know about this is by the end of the year, most people think the baseline interest rate in our economy will be between 4% and four and a quarter. What does that mean for you? That means you're going to be doing well by the end of the year to get four and a quarter, 4.5% on a CD. Okay. Now, previous to this, I thought they might even go lower than that, but they've kind of backed off that a little bit. And so, kind of again, in terms you can experience on a day-to-day level, I think we're going back into the 3% interest rate world within the next 12 to 18 months here. And that has all sorts of implications, which, if anybody's interested, I can go into more, but I don't need to get even more technical than I already have been. Okay, what are our projections for the unemployment rate and for GDP? So again, these are projections. You can see there's future dates here. Projections are that the economy will still grow through the year. All that you should really care about there is that those numbers are positive under right above my head here, this new column versus negative. Okay. We're projecting that the economy will grow throughout the year. We don't predict that we will have a recession this year. Okay. So maybe that's what I should have said the first minute we got on. I don't think there will be a recession this year. I did not think there would be a recession last year. There was not. A lot of the big companies thought there would be a recession last year. There was not. So, differing people can disagree. I haven't really seen very many people predicting a recession this year, though. So I guess in some ways that could make you nervous because it's like, yeah, everybody kind of agrees there won't be a recession. That's probably when it'll happen. But if you look at the numbers again, they don't suggest a recession. And if we project for unemployment, yes, I think unemployment will tick up a little bit to north of 4%, but I don't think it's going to be, people getting mass laid off or anything. Unless, the federal government, that may have an impact. That remains to be seen how that's going to shake out. I know there've already been people getting laid off. Um, by the way, if most of the people we work with happen to be state of Minnesota or local county, city employees. If you know federal employees, we know their benefits really well too. So if you know somebody who's in that situation where they're like, "Hey, my job just got eliminated. I got to figure out if I can retire or not." We absolutely can help with that. I've had people ask me, "Do you work with anybody but, county or state employees?" Yes, we do. So important to reiterate that. Pulse of the jobs market. I'm not even going to get into that because I think that slide is we've already talked about it. What's ahead for interest rates? The Federal Reserve meets kind of every 45 days or whatever, basically. So not quite every month, but or I should say they meet every month, but the committee that determines interest rates doesn't meet every month. That's an important distinction. So they meet now 7 more times this year. Does that mean that they could cut rates 7 times this year? Yes. Will they? Almost certainly not. They're probably only going to cut rates maybe a couple times based on what they're telling us right now. Again, what that means for all of you, you're probably going to be able to get decent rate CDs and money market accounts for at least the next 6 months, probably the next year. If any of you have looked at CDs lately, you're probably finding that they're only offering 6 to 9 months. Not that they're only, but the best rates are 6 to 9 months right now. That's because the banks are anticipating rates are going to go lower. And if they can get you to lock in for only 6 months instead of a year, they'll renew you for the next 6 months at a lower rate because rates will be lower. That's the thinking anyway. Again, nobody knows that for certain, but I think it's a pretty good bet that rates will be lower a year from now than they are right now. And finally, where is the market going to end up? Now, I showed you how all of these companies were wrong last year. So you might say, well, what makes you think they're right this year? And I don't necessarily think they're right. What I'll tell you, though, is all of them do think the market will go up this year. By differing amounts, again, where we started the year or where we ended last year, I'll just go back and refresh your memory because this is in points. 5,800, 5,881, and where all of these companies think we are going to be for next year is in the mid to high 6,000. So that's potentially around 10% growth. That's about what a lot of these places are predicting, about 10%. If I had to pick over under 10%, and I really don't get into doing that very often, but if I had to, that's a tough number. I hadn't thought about that before. I might go under, but a very slight under, and that's my cautious optimism part. But it very easily could be a 10% growth year. I think the numbers suggest that that would very much be reasonable to predict based on where we are now. So I've had a lot of people, I'm sure many of you on this call, who have been, for one reason or another, nervous about the market, saying, "Do we need to make any changes? Should we be getting safer right now? What's the deal?" Not everybody, but I've had a lot of that. And I don't think right now is necessarily a time to be bailing out of the market. Even though I've already said it's high and there are some risks out there, totally true in my opinion. But I don't think it's time to be bailed out. And one of the reasons is it's incredibly value to stay disciplined with where you're at. Okay. And one of the ways I can kind of explain that is if you go back over, it doesn't say how far this goes back, but I want to say this probably is the entire history of the stock market. Okay. I guess if there's 87 10-year periods, that means there's at least 87 years. Um, Yeah, it doesn't actually say, but the exactly what the time frame is. But this is a long history. So what this is the stock market, okay? And it's saying if you take any 1 year period, any 365-day period, and you slice it up, how many of those 365-day periods are up, and how many of them are down? Meaning, would I have wanted to be invested or not? Well, 73% are up in the recent history. So that means 73% of the time you're going to get a 365-day period where the market is up. That's a pretty good odds. People say, well, isn't investing kind of like a casino? And I'll say, well, I mean, yes, there's risk. So in that way, it's like a casino. But imagine if the slot machine at the casino had 73% win odds. I would be sitting there. You would be sitting there all day playing that one. And B, the casino would go out of business, right? So the market's not going to go out of business, so we might as well be at that slot machine if I have to make that metaphor. I usually don't like that metaphor because I think it's misleading, but if you want to actually make it, 73% of the time the market's up. If you extend that to a 3 year period, so say, hey, Anthony, I'm not going to retire for 5 years or 3 years, or I am retired, but I've got a 3 year window on any of this stuff. Well, then 84% of the time you make money by being in the market. So those are even better odds. If you extend it to 5 years, it's 88%, and 10 years, If you're in the market, not getting in and out or trying to time it, which I think is a losing game, but sticking with it over 10-year periods, 94% of the time you're going to make money based on recent history. And history is not a guarantee of the future, don't get me wrong, but it is historically true that this has been the case. And that's why we strongly advocate for everybody. And everybody's different, so you all have slightly different advice. But in general, stay diversified, don't get over concentrated, but stay invested as well. Because if you're willing to take the long approach, you do well. You turn it from this chaotic short-term thing where nobody seems like nobody knows what's going on to this long-term play where we have good data to suggest, yep, if you're willing to wait, the odds are in your favor that things will come out, and they're strongly in your favor. So, steps for you to take, keep us informed if something changes with you. If you're not retired yet and you really are wanting to pick that, let's talk about it. We can help you figure that out. If you are retired, obviously, just let us know if something's going on that we need to be aware of. Tell us about what you're concerned about, right? Reach out. I never get upset if somebody says, and I've had this before, Anthony, I'm really sorry to bug you. I'm sure, this is just something that I could figure out on my own, but I was worried about it and I wanted to get your take on this. It could be a specific thing. It could be, hey, I've just been watching the news and I'm a little freaked out. Tell me what you think about it. I'm trying to do that right now in general, but specific to you, I am more than happy to go into that. We can set up a phone call. I can shoot you back an email. Whatever works for you. Don't ever hesitate to reach out to us about that. That's exactly what we're here for. And then lastly, and this is good as always sort of a thing, make sure your essential documents are up to date. Let's make sure if we haven't looked at it recently, which we probably have, but go over your beneficiaries. If you need to talk to somebody about a will or a trust, let us know. We can talk through it with you, just with us. But then if we need to take the step to go to a legal professional, we can recommend some great people there. Just make sure things are organized well. And if you need help with that, most of you know we have a great booklet called the What If I Die Workbook, which is what it sounds like. It sort of or helps you organize everything for loved ones who will be around after you're no longer here. It's a great proactive step. Doesn't cost you anything. Just let us know if you'd like a copy. We can email it to you, and it's a fillable PDF, so you can save it, you can print it, you can do whatever you want with it. It's fantastic. Um, and then steps for us to take, for me to take. We're going to continue to keep you informed. We do a webinar every month. If this is your first one by chance, watch your inbox. You'll get an invite for next month. We're going to continue to manage your investments according to you, not just what the market's doing, but how it fits with you. And we will continue to keep you informed as any changes are made necessary, whether it's because of policy or politics or just the markets and the economy. And we're going to continue to inform ourselves so that we can give you the best possible advice. That's number three there. So we've made it, and we're 1 minute before one, so I got it done in less than an hour. Hopefully that elucidated, at least you know how we're thinking about it. I know all of you are thinking about it individually as well, but I think it's an incredibly important time to have a professional like us who you can lean on for this stuff to help distill the signal from the noise, right? Because there's a lot of noise right now, but how much of it's really going to impact your life or your investments is different for everybody here. All right. Well, I'm not seeing any questions come through, so I think we'll leave it there. I will end the poll so we have the results. And thank you, everybody. I hope you have a great rest of your day. Take care.